Gold fell $500 in one day. Silver crashed 36% in 48 hours, the largest dollar value destruction in precious metals history. And while every financial outlet on earth is telling you this was a market reaction to a Federal Reserve chair nomination, what actually happened was a coordinated government operation to save the dollar. This was not a market sell-off. This was an orchestrated attack, executed through the futures market, timed with precision, amplified by media narrative, and designed to break the momentum in precious metals before it spilled over into the foreign exchange market and the bond market in ways that would have been catastrophic for dollar credibility. This is the story of what actually happened on Thursday and Friday. Not the cover story about Kevin Walsh being a hawk, the real story. The short selling, the timing, the narrative coordination, and why the people who executed this attack are now trapped in positions they cannot close without driving prices to levels far higher than where this began. Let me show you what happened in sequence. On Thursday morning, silver was trading above $120 per ounce, all-time record high. Gold was above $5,550, also record high. The dollar index had fallen to a 4-year low. The dollar against the Swiss franc had hit an all-time low. Treasury yields were starting to move higher, bond prices rolling over. The market was sending a signal. Dollar credibility is eroding. Inflation expectations are rising. Trust in U.S. monetary policy is failing. This was a crisis, not for precious metals investors, for the U.S. government. Because when gold and silver rise to record highs while the dollar falls to multi-year lows, that's a vote of no confidence. That's the market saying, we don't believe your inflation numbers, we don't believe your debt is sustainable, we don't trust your currency, and when that signal gets loud enough, it spreads. From precious metals into foreign exchange, from foreign exchange into bonds, from bonds into a full credibility crisis, the kind that forces central bank intervention, the kind that triggers emergency policy changes, the kind that ends badly. So what happened? Thursday afternoon, in a 10-minute window, gold dropped $300. Silver crashed even harder. Percentage-wise, the decline was unprecedented for the speed, not the magnitude. Silver has fallen 36% before. Gold has dropped 10 to 15% before, but not in 2 days, not in hours. This was different. And if you understand how markets work, if you understand how professional traders operate, you know immediately this was not normal selling. Because if you have a large position you want to exit, you do not dump it all at once on the market. You work the order, you sell gradually, you minimize price impact, you get the best execution possible. That's how professionals sell. But Thursday's selling was not professional selling designed to get good prices. It was dump selling designed to move prices. The goal was not to exit a position profitably. The goal was to crash the price, to create panic, to trigger technical breakdowns, to shake out leveraged longs, to reverse momentum. This was an attack. And the attack came through the futures market, not the physical market. The sellers did not own gold and silver. They sold contracts, paper claims to metal they do not possess and cannot deliver. Short selling on massive scale, hitting the bid with enormous size, overwhelming the market, driving prices down in minutes. And here's how you know it was coordinated, the timing. Thursday afternoon, just before the weekend, giving maximum time for fear to build. And then Friday morning, earlier than expected, President Trump announced his pick for Federal Reserve Chair, Kevin Walsh. And the moment that announcement hit, a coordinated media narrative launched. Walsh is a hawk, an inflation fighter, a critic of quantitative easing, a hard money advocate. The opposite of what markets expected. Markets had priced in a dovish Fed. Rate cuts, more money printing, Powell getting replaced by someone who would do what Trump wanted. Easy monetary policy to support economic growth and asset prices. The gold and silver rally was built on that expectation, and the Walsh announcement was positioned to destroy that narrative in one move. But here's what the media is not telling you. Kevin Walsh was not a surprise pick. He was a frontrunner from the beginning. Not the top choice, but easily a 30 to 40% probability candidate. He was one of the top 3 names on every short list. So the idea that this was unexpected, that this was a shocking development, that this changes everything, that's manufactured narrative. The administration coordinated with media to position Walsh as more hawkish than he actually is, to create the impression that Trump has abandoned his criticism of Jerome Powell, that Trump no longer wants rate cuts, that Trump is now prioritizing inflation, fighting over economic growth, that the entire easy money expectation was wrong. This is narrative manipulation, and it worked. Gold and silver sold off another leg on Friday as the Walsh story spread. The technical breakdown from Thursday, combined with the narrative shock from Friday, created a liquidation cascade. Margin calls, stop losses, algorithmic selling, forced unwinding of leveraged positions, and at the bottom, the shorts who initiated the attack on Thursday got to cover at prices far below where they sold. Now, let's talk about why this narrative is false. Donald Trump has spent his entire presidency and his entire campaign criticizing Jerome Powell. Why? Because Powell did not cut rates enough. Trump wanted bigger rate cuts, more aggressive easing, lower interest rates to support growth. He said this publicly, repeatedly. He told everyone he wanted a Fed chair who would cut rates. And the gold and silver market believed him. That's why metals hit record highs, because markets priced in easy money. But now we are supposed to believe Trump changed his mind, that he no longer wants rate cuts, that he is appointing an inflation hawk who will raise rates instead. Think about the logic. Trump criticizes Powell for not cutting enough. So Trump's solution is to appoint someone who will cut even less and maybe raise rates? That makes no sense. The only explanation that makes sense is that Walsh is being positioned as a hawk to provide cover for the rate cuts that are coming. To create the impression of Fed independence so that when Walsh does cut rates, markets will think it's justified. It's the same playbook. Appoint someone who looks tough. Let the media call them a hawk. And then when they ease policy, everyone assumes it must be necessary because otherwise this inflation fighter would not be doing it. Kevin Walsh has his orders. He will do what the administration wants. If that were not the case, he would not have been selected. The public positioning is theater. The actual policy will be accommodation. Rate cuts, balance sheet expansion, whatever is necessary to prevent recession and support asset prices. But the short-term goal of the announcement was not to signal real policy. It was to break the momentum in precious metals, to create doubt, to trigger selling, to buy time before the next leg up, and it worked, temporarily. But here's the problem for the shorts. They are still short. They have not covered. If they had covered, prices would be higher, not lower. They sold metal they do not own, contracts they cannot deliver, and now they are trapped. Because the real buyers, the physical buyers, the ones who were buying gold at 5,500 and silver at 110, they are not stopping. They are buying more. The decline in price is not reducing demand. It is increasing it. Because physical buyers understand what paper traders do not. The fundamentals have not changed. The debt is still unsustainable. The deficits are still exploding. The dollar is still losing credibility. The bond market is still rolling over. Nothing about Thursday and Friday changed any of that. All that changed is the paper price. And paper price disconnected from physical reality creates opportunity. The premiums on physical metal are already rising. The spread between paper price and physical delivery price is widening, because demand for actual metal is increasing while supply remains constrained. And as that spread widens, the pressure on short sellers increases, because eventually someone is going to demand delivery. Someone is going to say, I do not want to roll my contract. I want the metal. And when that happens, the shorts have two choices. Buy metal in the physical market to deliver, which drives the physical price higher, or default on the contract, fail to deliver. And if they fail to deliver, the entire futures market credibility collapses. So they must cover eventually. And when they do, the buying pressure will be enormous. Here's why this attack was necessary from the government's perspective. Gold and silver at record highs, dollar at multi-year lows, bond yields rising. These are signals the market is losing faith. Not just in precious metals terms, but in currency terms, in credit terms. If gold keeps rising while the dollar keeps falling, that becomes a self-reinforcing loop. More people buy gold. More people sell dollars. Dollar falls further, gold rises further, and at some point, that loop breaks dollar hegemony. It forces other countries to question why they hold dollars, why they hold treasuries, why they accept dollars for oil, for trade, for reserves. The rise in precious metals was becoming an existential threat to dollar dominance, so it had to be stopped, slowed down, broken, even temporarily. The mechanism was simple. Massive short selling in futures markets on Thursday, media narrative coordination on Friday, create fear, trigger technical selling, flush out leveraged longs, and buy time. Time for what? Time to implement policy responses. Time to coordinate with allies. Time to stabilize the dollar before the sell-off becomes uncontrollable. This was a defensive operation, emergency measures, because the alternative was worse. The alternative was gold, continuing to 6,500, 7,000, 8,000, while the dollar continued falling. And at that point, intervention becomes impossible. The market is too big, the momentum too strong, the credibility too damaged. But the intervention has a cost. It exposed the mechanism. It showed that when precious metals threaten dollar credibility, the government will coordinate to suppress them. It confirmed what many already believed. The paper market is manipulated, prices are managed, free markets do not exist at this level. And that confirmation, that proof of intervention, it does not reduce demand for physical metal. It increases it. Because if the government has to attack gold and silver to protect the dollar, that tells you everything you need to know about which asset has real value. So what happens next? The shorts are still short. The physical buyers are still buying. The fundamentals have not changed. The debt is still unsustainable. The dollar is still losing credibility structurally. And the credibility of the paper market has been damaged by this obvious intervention, which means the next move up will be bigger because more buyers will bypass paper markets entirely. They will go straight to physical, bars, coins, allocated storage, and when that happens, the paper market loses its ability to set price. The premiums widen until paper becomes irrelevant. And at that point, the real price discovery begins. Not in Chicago, not in New York, in Shanghai, in Singapore, in Zurich, where physical metal trades, where delivery is required, where paper claims mean nothing. The crash on Thursday and Friday was not the end of the bull market. It was confirmation that the bull market is real enough to threaten the system, real enough to require government intervention, real enough to coordinate attacks, and if it is real enough for that, it is real enough to continue. The shorts will cover, the physical buyers will accumulate, and the next leg higher will be faster than the last. Because everyone who got shaken out has now learned the lesson. Paper is vulnerable, physical is not. And the divergence between them is the opportunity of a generation. The crash was a trap for shorts, not longs. They sold at the top of the move thinking they broke it. They will buy back at prices far higher than where they sold, because the intervention bought time, but it did not solve the problem. The problem is structural. Debt, deficits, dollar debasement. And no amount of coordinated short selling changes that. The attack confirms the thesis, and the thesis says gold and silver are going higher, much higher. The only question is how many more interventions happen before the market overwhelms them completely.